Hi, greetings of the day. This is Professor Ramkrishna. Welcome to my YouTube channel Archiversity. Along with this YouTube channel Archiversity, I also have a website archiversity.com. Using these two platforms and other online educational platforms, I teach courses in finance and accounting and other quantitative subjects of management, commerce, and accounting to the students across the world. In my previous lecture, I explained you the difference between capital and revenue expenditure. This lecture is on definition of capital and revenue receipts, distinction between capital and revenue receipts, and we also solve a worksheet to understand our learning of capital and revenue receipts. So this is a three-stage one. One is a definition, second one is a distinction or a differentiation, and the third one is a practice session. Receipts to business entity will come from two sources. One is from a capital receipts and the second one is a revenue receipts. And when it comes to the capital receipts, so capital receipts are from financing and investing activities, whereas your revenue receipts comes from revenue from operations and other sources of income. Now, how is it we are going to differentiate this is that or define this as a capital receipt is an amount which the business receives to expand its operations, maybe in the form of owner's equity. Owners give equity or a share capital to expand the business, to purchase economic resources, or by investing activities, in the sense we invest some money in a project and at a later time period we sell that investment at a higher price. In that case we get a capital gain, or if we are selling it at a lower price then we incur a loss. So your financing and investing activities are of a long-term nature. And other way of getting a long-term capital is from a loans or borrowings from banks, financial institutions and all. So this amount is also used to procure economic resources. So this is related to the capital receipts. On the other side, when it comes to the revenue receipts, we have two classifications. One is receipts from operations. When we are saying that revenue or income from operations, that means this is a source of income which we generate, that is a business generate on offering goods and services to its customers. In the sense, take for example, ACC Cements is there. So ACC manufactures cement and sell the cement to its customers and generates a revenue. So this is the income from operations to the ACC Cement. On the other side, if you take an example of a TCS, the information technology company, Tata Consultancy Services, which offer information technology services to its clients, and by offering these services or by developing a software projects for their clients, they generate a revenue. So that income is called as a income from operations. And the second source is other sources of income. Now when business earns some money and some part of it it distributes to the equity shareholders, some it retain as retained earnings and invest in a short-term investments or long-term investments, like investments into shares or investments into fixed deposits, investments into government bonds, etc. So any income that the business earns from these sources is called as other income. Suppose it made an investment in a fixed deposit and earned rupees 1 lakh as a interest on this deposit. So this interest on deposit for that particular year is your other sources of income. Suppose a company invested into shares and it received a dividend. So any dividend amount received, let us say dividend amount received is 10,000. So this dividend amount received during the particular year, so this is again another source of income. Then bonds, again interest. So but if a company earns capital gains on this, in the sense of shares are purchased at a lower price and sold at a higher price, then that is not a revenue income, it is a capital receipt. Now from this we can make a classification that revenue receipts are the incomes either in the form of an income from operations or other sources which pertaining to current financial year or a fiscal year. Whereas a capital receipts have impact for a longer time period. So based on this, we'll try to judge whether a receipt is a capital receipt or a revenue receipt. Why this differentiation is important is all the capital receipts are shown in your balance sheet, whereas our revenue receipts are shown in a profit and loss account. So any error in committing this will jeopardize your total final statements or final accounts. So you need to be very clear about whether a given receipt is a revenue receipt or a capital receipt. So now we look at the distinction between revenue receipt and a capital receipt. Here you can see a capital receipts are income from non-recurring stream or unusual operations. So unusual operations is issuing of a shares, borrowing a loan, or selling of part of your investments and all. Whereas the revenue receipts are income that is earned from a day-to-day operations. As I explained you, in case of a ACC, a cement manufacturing, selling a cement bags or cement is a day-to-day operation. For TCS, developing a projects or providing a software services is a day-to-day operation. So any income generated by performing day-to-day operations is a revenue receipt, and unusual, occasional are capital receipts. And the sources of receipts are capital receipts are received from financial and investment activities, financials in the form of owner's equity or a borrowings or by issuing a debentures, by issuing notes, etc. Whereas when it comes to investing activities, investing into a project, selling a project at a higher price and gaining a long-term gains or losses, that is a source for a capital receipts. When it comes to the revenue receipts, these are received from the sales, the discount received from a customers, so our commission received, and these are all examples of a revenue receipts. The nature is as recurring one, non-recurring is a capital, and a recurring is a revenue receipt. So condition is that capital receipt must create a liability or lead to reduction in an asset. When it's saying that creating a liability is, suppose you borrowed a loan, so you owe that money to the bank or a financial institution or someone from whom you borrowed a loan. So it is creating a liability. So that's the reason why it becomes a capital receipt. Or on the other hand, it's a reduction in an asset. So you purchased a piece of a land and you sold this land, then you made a revenue. When you sell your land, your asset will decrease. So decrease in a land is that is a cash generated by selling an asset is a capital receipt. Next, revenue receipt must not reduce the asset nor create any new liability. So no new asset, we will not sell any asset nor create any new liability in case of a revenue receipts. Next, the term or a duration. Capital receipts are for a long-term nature. Maybe equity, when a company issues equity shares, then this is for a perpetual time period, infinite time period. Or when a loan is borrowed, loan we borrow for a 10-year, 20-year, likewise. Whereas the revenue receipts on the other hand are a short-term in a nature, probably day-to-day or within a financial year is a revenue receipt. Next, reserves. Capital receipts are not used to create reserve fund, whereas revenue receipts can be used to create a reserves fund. Revenue receipts, like you generate income or you make a profit at the end of the year. Using this profit, we generate a reserves funds, and these reserve funds will go to the equity holders at a later time period. Now, when it comes to the accounting treatment, capital receipts comes in a balance sheet of the company, whereas the revenue receipts are shown in a profit and loss account. The purpose is very clear. Capital receipt is used to meet a capital expenditure, that is procuring or mobilizing the economic resources of a company like a plant, equipment, machinery, patents, copyrights, investments, or paying our debts, etc. On the other hand, revenue receipts are used to meet revenue expenditure, in the sense whatever the revenue that we generated during the particular year, part of that amount we use to pay the costs incurred to generate that revenue. Examples are rent, electricity, salary, and all. Impact of a profit and loss account. Cash receipts do not have direct impact on profit and loss account, because most of the times we show this in a balance sheet, whereas revenue receipts have direct impact on your profit and loss account. Now, impact on a balance sheet. Your capital receipts will have impact on balance sheet either by increasing a liability or decreasing asset, whereas a revenue receipt has no direct impact on the value of asset or a liability, because revenue receipt only if you are making a profit, that is shown as a reserve and in the liability side, so it is not going to have a direct impact. So these are the major differences between capital receipts and revenue receipts. Now we check our understanding of a capital and revenue receipts with the given statements here. First one is introduction of a capital by the owner. This is 50 lakhs. So when a owner invests money into the business, here we are creating a liability, or there is an increase in a owner's equity. So this is capital receipt. Now, sale of goods for cash rupees 1 lakh. You are making a sale of a goods. So sale of goods is your day-to-day activity or your operations. So this is revenue receipt. Now, old computer with a book value of rupees 10,000 sold off for 8,000. Now here what happening? Old computer is your asset and there is a decrease in a value of your asset. That is 10 lakhs of asset, you are selling it. So there is a decrease in a value of your asset and you are selling it at 8,000, that is a 2,000. So this is a capital. This 8,000 that you are receiving is capital receipt and 2,000 is the loss, capital loss. Next, cash received from debtors 2,50,000. So debtors you are creating on a day-to-day basis. All right. So here you when you make a sale, you create a debtors, and a debtor is an asset, right? When you are creating an asset, and here when you are receiving a cash from asset, there is a decrease in your debtors. So this is your capital receipt. But other way, you can see that debtors are part of your day-to-day activities. Simple terms, you are making it as a credit sale. So after a certain time period, you are receiving this. So that is the reason why we consider this as a revenue receipt. Simply, we are making an assumption that we sold the goods on a credit basis to our debtors and we collected the amount in the same financial year. That is the reason why we are considering this as a revenue receipt. In simple terms, credit sales, that is amount received from your debtors. Next, a short-term investments standing in the books at rupees 1 lakh was sold for 1,50,000. So here you have an investment. This is an asset which you created, a long-term asset, and which is of 1 lakh sold for 1,50,000. So this amount received is your capital receipt, because you are selling a long-term asset here. Whereas in case of a debtors, it is a short-term obligation and it is a part of your regular activities. That is the reason why we consider it as a revenue receipt. Whereas here an investment is considered as a long-term one or non-business activity. So this is a capital receipt. Next is interest received on investment. So this is an interest amount. So we received this. This is a revenue receipt, but not from operations, not from a core activities. So we consider this as a other income. Income from other sources is your interest received. Then took out a long-term loan from a bank. So when you took out a loan from a bank, your liability will increase. So creating a liability increase. So this leads to your capital receipt. Next, cash discount received from the supplier. So cash discount that you're receiving from your supplier is part of your day-to-day activity, and this is part of your regular operation. So this is a revenue receipt. Now received sales commission rupees 10,000. Again, this is a sales is your regular activity or day-to-day activity. Any income received from your operations is a revenue receipt. So this is how you need to make a differentiation between capital and revenue receipts, and also see that you accurately classify them as a revenue receipt or a capital receipt, and accordingly you need to post these into a concerned balance sheet or statement of profit and loss. So thank you for listening to the lecture. See you soon with a new topic related to financial statements.